Good morning and welcome to Thinkmarkets analysis. I'm here with a critical update on the Kiwi, which just took another hit, and we are now sitting at April levels. Yesterday was all about dollar strength, and the fundamentals also are actually lining up with what we are seeing on the charts. So let me break it down. So first, let's start with the dollar index. It was strong yesterday and it surged. Okay, two consecutive actually days so far. And one, we had US jobless claims, which crushed expectations. Second, GDP revision to 3.8 from 3.3. And that, both of these reports come after Fed Chair on Tuesday said during his speech that there is there are two-sided risks. So emphasized, yes, okay, we do focus on unemployment, but inflation still, of course, something that we need to consider. So the result, the index took over the 98 level and could be heading towards the 100 psychological level, but it really needs to break this downward trend line. Now, on the Kiwi, on the domestic front, we had a poor GDP contraction in Q2. To be fair, in contrast, the RBNZ is under pressure to cut more aggressively, and markets are actually pricing in a 50 basis point cut in October. Okay. Now, we also got the Governor Anna Bremen starts in December. That was an announcement from the central bank. But here's the thing: by then, the cutting cycle pretty much might be done. So acting Governor Hokesh Bai is handling the October and November meetings where the real action is happening. So when you've got the dollar ripping higher and global uncertainty also brewing, because Trump also announced new tariffs yesterday, high beta currencies like the Kiwi can get hammered. We have got a head and shoulders here. Let's just pass on to the Kiwi. For me, it looks like the left shoulder is here, the head is there, and potential for 61.8 down at 57 is possible. There are different ways to see this. One would perhaps even call this the left and the right shoulder. Any way you look at it, the larger structure tells us that this breakout at any level you look at it, even with the neckline or just on a support level, might have more room to go down to around the 61.8. The RSI has not reached oversold as well, which equally suggests more room to the downside. Now, comparing that to dollar strength, okay, and we have to do that, of course, the dollar, one way or another, also has room to go from current levels up to around 98.50 at least. And the RSI momentum also shows that there is more room to go higher up. Okay, so the interesting thing is that we have broken, of course, lower down, and we are heading to the golden Fibonacci level, as we call the 57.21. So I would say perhaps a move down to 57 initially would be something possible. That's also where the sort of support from the swing low in early January, was okay before we bottomed out. And of course, if, and that's a big if, the index breaks above that level and goes towards the 100 psychological resistance, then we could see QE sliding all the way down to the 78.6 Fibonacci at 56.20. This obviously is going to take the RSI in quite of an oversold territory. But essentially, what I am looking currently, because we do see two troughs on price and RSI, there is no hidden divergence to indicate that there is a potential for a bounce. What I am looking at is potentially down 61.8. And of course, we can get a bounce and further continuation to the downside. That's the one option. The other option would be to, which I think it's more of like a scenario, to pull back and try to come towards the 58 once again. Now, this area, if this happened, is going to tell us whether Kiwi is going to retest that level and continue lower down. Okay, of course, it will have medium-term implications with a short-term upside, or it could just break higher and move towards new highs, which I'm not sure. I am too confident, at least at the moment. Now, if something like this happened, it would also give us on the RSI a potential divergence. So we would be looking at, essentially, there is two scenarios. One is this. So it would move, we do something like that. Okay, so we'll have the hidden divergence and moving up. The other scenario would be that we do another low, okay, and then we are going to remain below this territory. So maybe it's going to drag a little bit lower and it will create a larger hidden divergence. But anyway, you look at it, you know, we have, we are approaching a critical technical level on Kiwi. And one way or another, regardless of what the technicals are telling us, today we do have the US PCE. So this is the Fed's favorite inflation gauge, of course. And if it comes hot, we're not going to see any sort of recovery. Okay, we're probably going to go to the 61.8, break through it, and then continue lower down. Okay, so the trading setup for now is bearish, especially as we remain below the 58 resistance. We losing the 61.8 would open the door down to 56.20, and potential rallies towards the 58 would be probably an opportunity to sell in the short to medium term if the PCE is, I'd say, neutral rather than just hawkish. If it's hawkish, we'll probably go straight down. If it's neutral, maybe we'll see a bounce to 50 and then continuation to the downside. And if it is dovish PCE, which means if PCE numbers will come not hot, right? So below expectations, then we could see Kiwi bouncing even from current levels up to around 58 or so, and perhaps even a little bit higher. Maybe we're going to go towards the territory at 38.2 if it is dovish. But I think any sort of pullback would, for me, be considered more of a like situation where can be sorted. If that happens and the PCE is dovish, I would be looking at 38.2, which comes around the 58.50 from current levels. Okay, and this potential scenario, of course, would be again bearish, and we would be targeting again the same levels to the downside. So that's your Kiwi update from Thinkmarkets. Keep those levels on your radar, and we'll catch up to you in the next session.